Hello, everyone. Thanks for joining today. My name is Mike Vanoy. I'm the Vice President of Product Development and Marketing at Assure. And we've got a really big topic today. It's the ERTC, the Employee Retention Tax Credits. To me, this topic really kind of got swept under the rug a little bit for how big of a deal this is in 2020. And with legislative changes on December 27th, and even further changes with the American Rescue Plan Act, ARPA, on I think March 11th from the Biden administration. This has changed yet again to have all kinds of new enhancements, and now that we're kind of getting through PPP madness of this last year, that this is probably going to become maybe the biggest topic that we have for the small businesses have for maybe call it the next 6 to 9 months probably. So joining me today is Terry Kirby. She is head of tax filing and compliance at Assure, and a familiar guest on this web series. So Terry, welcome back. Love talking to you about this stuff.
Thanks. Looking forward to
it. So just a quick prelude. If you're a regular listener here, you know that Terry represents Assure on with an organization called the NPRC, the National Payroll Reporting Consortium. This is a lobbying agency. This is a group that basically consults with Department of Labor, Small Business Administration, IRS, Treasury. So when Congress passes these large sweeping laws, of which there have been huge ones in the last year, 18 months, they don't always necessarily understand the nitty-gritty of in the unintended consequences of how to implement these things. So the NPRC has a seat at the table that is non-vendor preference. It's vendor agnostic. You can see all the big names that have a seat at the table, just like we do, to really kind of advise and consent here and help steer these massive agencies on how best to implement these laws. So at the end of the day, you're gonna need to determine your own eligibility because this stuff is wonky. This stuff is complex, and there's gonna be a bunch of you guys who are gonna say, "Oh wow, I easily qualify, no big deal." There's gonna be tons of shades of gray. We could spend hours upon hours upon hours having all kinds of experts from a legal and a CPA perspective, tax law. Kind of getting into the gray areas on the fringes of whether you do or don't qualify. At the end of the day, you're going to need to make the determination whether you qualify or not. The purpose of today's webcast is to make sure everybody understands the basics of this law. What are the basic qualifications? What can you qualify for? And what I want to really hit here, I think PPP just sucked all the oxygen out of the room in 2020. So when CARES passed in March of 2020, all the money went to PPP, right? And I shouldn't say all the money. There was definitely big money in employee retention tax credits, but it was complex then, just like it's complex now. And because there was, in most cases, more money available, it was infinitely simpler for small business owners. You could just go to your bank and your bank would just tell you what you need to do, right? Are you shut down? Are you impacted? Do you qualify? Yep, okay. Give me your last 2.5 months worth of payroll reports to see what you qualify, and let's get you a loan. And if you use the money in the right way, you get the money for free. It was pretty darn straightforward, even though there was maybe a lot of ambiguity in early days. It was a heck of a lot simpler to understand than the ERTC. So I think people just simply forgot it. But one of the big reasons why this is such a hot topic now, and I'm jumping ahead a little bit, when the law changed December 27th, retroactively, we can go back to 2020 and file these returns. And we'll talk eligibility in just a second. But I just want everybody to understand, these are big stakes, right? So for 2020, we're talking up to $5,000 per employee. For 2021, up to $28,000 per employee. So if you're a business who's been hit hard by COVID and you have only 10 employees, you could be looking at as much as $380,000. If you have 50 employees, you could be looking at nearly $2 million in stimulus. Now, to be clear, we're not giving any advice. We're not trying to line owners' pockets. We only want to help people follow the law to get the stimulus that is available to them should they qualify, and we'll talk about how we can help with that. So these are big dollars, and we want to help get you in the path of those dollars, right? So if you've been impacted and you qualify, this is money that just the kind of dollars that just simply cannot be ignored. Dare I say, malpractice of a business owner to not deeply pursue these paths. So with that, Terry, let's just kind of jump into the topic. I want to do a little deeper dive into some of these bullets on the screen, like the amount of the credits, the eligibility, max credits. What if you have more or less than 100 employees? And we'll talk the 500 employee mark, how that moved. What's the interplay of PPP, et cetera. But first, let's just unpack the changes, because it's a little bit dizzying, right? So
Definitely.
let me kick it off, and I'm going to kind of hand it off to you. The trigger event, I think, really here, so there's three major pieces of legislation. There's CARES, which happened in March 27th of 2020, the Consolidated Appropriations Act, CAA, which is the outgoing Trump administration. The big thing there was they kicked off PPP second draw, right? But
Yep.
less publicized retroactivity for employee tax credits for 2020, which is really a huge impetus of today's webinar. And then the Biden administration American Rescue Plan, which kind of doubled down, if you will, and added some new eligibility, some new benefits, also some new rules to the CAA, right? But it's this first one here, this retroactivity where originally you had a choice. You could either take PPP money or employee tax credits.
Correct.
But December 27th, that all changed. Let me kind of hand it over to you for a bit, Terry. Walk us through what happened.
Well, initially, you're right. The PPP loan was out there. The intent was to get money out there to the small business employer quickly so that they could at least retain their employees, maintain their employees, and maintain their business for the recovery. I think it was because we also thought that COVID wasn't going to last the whole year. It was going to be over in April, and then it was going to be over in July, and it kind of eluded us to being complete. So that's what caused some of that extension. The employee retention credit was for those employers that were going to either very small business employers that were staying in business that were still trying to work. They either had their other qualifying events, whether they were their gross receipts, but they were trying to maintain their employees and keep in business. Or you have a little bit larger group where they're actually paying employees to not work while they're waiting for the relief to be eased by the government mandates for shutdown and stuff like that. And then we walk into the Consolidation Appropriations Act, which at that point in time, it opened up more because we had many PPP releases throughout the year after March, which kind of clarified, forgiveness plans, layouts. Is it 8 weeks? Is it 27 weeks that we're looking at for the calculations? And as that expanded and we kept rolling into that extension of the COVID impact to governments, we had re-shutdowns in October, November, and then back up again. I think that's what brought this next step in. So then there was more clarification on some of the PPP legislation. But then that December 27th date, it also said, okay, I'm opening it up, and now employee retention credits retroactively can be available for those individuals that took a PPP loan, but not for those PPP wages paid, which meant, oh my gosh, now I've opened up Pandora's box. I've got more credits that I can go for. And all of this was with the intent of getting money back into the business quickly so that we could recover. And now with the American Rescue Plan, it's looking forward to saying, okay, we know that some of us are still not quite at that recovery level. And, with having the shots coming up in our vaccination plans and stuff like that, we're hoping that, we're going to have a better future, but we're still in recovery mode. And now it's even expanded it more in that you can have your PPP, you have PPP2 for those that, had their first loan, they've used it, they received information, whether it's forgiveness or not, and they were able to reapply for additional loans and grants, which started with the CPPAA. But then in addition to, now I've got a recovery that may take us even all the way through the end of 2021.
Right, right. Okay, so we're gonna do deeper dives on each of these buckets, but so the punchline that everyone should walk away from here, if you didn't know it, and I kind of feel like this is the best kept secret in the small business world today. Even if you applied for and got your PPP loan in 2020, originally you were not eligible for those tax credits. I feel like that was kind of a water under the bridge. People didn't understand it. They didn't know about it. You can retroactively. So we're going to have lots of time to figure out 2021 together. But 2020, you can retroactively file amended returns to get this stimulus. So next row, let's talk about the company size. There's I think some confusion about this. 100 employees, greater than, less than, with the CARES Act. That was moved up to 500. But what does that even mean for the average small business owner?
Well, for the average small business owner in the beginning, they were really focused on the very small industry. Those individuals that had less than 100 employees and that they were just eking by. And so for the most part, for those employers, the CARES Act allowed the employer to utilize the employee retention credit basically for all employee wages that they paid. Now, keep in mind, you can't use it for any wages that you used for FFCRA credits because that's, double crediting yourself. But you could use it for other wages and any wages paid for that group. The employers that had 100 or more were still eligible if they could show that reduction in their gross receipts and or if they were shut down. But more at that point in time, those employers could only utilize and get credits based on monies that they paid to employees that were not working. So that they could retain them instead of them being added onto the unemployment rolls. They were looking at employees that they were paying, but not, you couldn't qualify for the FFCRA wages that you paid to an employee, and you couldn't qualify for situations like an employee knew that they weren't going to be able to work, so he's using his paid time off. Paid time off didn't qualify for a credit to those employers. It was only for wages that they actually paid to retain the employee, even though they weren't working. One of the examples I have.
Kind of goes back to the original intent, right? The original intent is, oh my gosh, we don't know what the future holds here. We don't want the bottom to fall out on our economy. And small businesses being the largest employer of individuals, rather
Right.
than everyone dumping to the unemployment rolls overnight, let's throw a bunch of money at this thing and incentivize businesses to pay employees essentially for not working, right? That's
Exactly. The intent, I think, even in that at that time zone was that we want to keep employees available because we want to get back to work right away. And again, we didn't know that it wasn't going to last. We thought it was going to be a short term, April, May, we're going to recover, and it didn't happen quite that way. And so that's how it kind of extended. And it's like, how are we going to make this thing that's a quick short term? I'm going to maintain my employees so that in the next 3 weeks, I can get back to work. I don't want the production line to drop so significantly that it's going to take me 6 months or whatever to recover. I need to be able to know that it's just a dip in the road, and it got bigger than a dip, more deeper pothole, more like it. But it's one of those that we tried to, that's what the intent was, to be able to keep people available and ready so we can get them back to work quickly. Yeah.
All right, so let's take the next swim lane here for who qualifies. Again, we could spend an hour on just this role alone, but you know, kind of bucket this for us. The qualifications, and I don't think there's any retroactivity to the qualifications. The retroactivity was to the PPP or not, but you know.
You're right. You're right. For 2020, the qualifications, they're still looking at that you had a partial or full disruption of services that you could render basically by government order. And in many cases, like with the CAA, they've recommended in a lot of the guidance that was provided there to make sure that you've got information that proves that to support your eligibility. Because if you weren't shut down by a government entity, the only other option is your gross receipts. Gross receipts at that point in time for the majority was to compare what your gross receipts for your business entity was to the same point in time in 2019. You needed to show in the beginning, you needed to show a reduction of 50% or more. And then your recovery is once I hit 80% of where I was at in 2019 or more, then the first of the next operating quarter, I would no longer be eligible for employee retention credit. With the CAA, because we all of a sudden we went a lot longer than just a couple of months, it's one of those I can look backwards for my retroactivity for the items. Did I have government disruption? Do I have a gross receipts item? And at that information, but now I'm better retroactively to view what the impacts were, especially, if I qualify. As a go forward, the CAA said January 1, now I've got a reduction in gross receipts that's different. I'm now comparing my 2020 gross receipts to the same point in time, or actually 2021 to the 2029, and do I show a 20%, or more reduction in gross receipts? Did I have, and potentially you still have some government disruptions, but I don't believe that they anticipate that to be the biggest item. I think the focus is on gross receipts, because if you're still significantly impacted, then you are qualifying as a January 1, 2021 and go forward. The change in the percentage doesn't go backward. It doesn't grow retroactive. And then again, they maintained that same piece in the American Rescue Plan, but then they started looking at some entities and how they were impacted. Like they're looking at more of government entities, aggregated companies where you've got multiple companies that are all related. And then there were some industries that were recovery startup businesses, which pretty much are just businesses that were involved in recovery, which were kind of ignored in the first ones, but they're looking at the special group of employers and how it impacted them and their processes. Because in most parts, they didn't have a reduction in work. They may have a reduction in gross receipts, yes, to qualify, but they may still have had and maintained work, so they weren't shut down. It's fine tuning a lot of the availability, and it's looking forward to the end of 2021 with the ARPA.
And I don't want to steal too much from a future slide here necessarily, Terry, but I want to, there's this context, I think, for the government disruption or the reduction in gross receipts. So this is not an and, it's an or. So it's not like, so if you can show government disruption, now the U.S. Chamber of Commerce says it's something like 23% of all small businesses had some type of a government shutdown. So that's a quarter of them, right? So that's going to be the easiest, biggest bucket. So pretty simple. If you got a mayor, or a county executive, health order, or government, a governor, or whatever it is, pretty easy to prove whether you disrupted a shutdown.
Correct.
All the reading I've been doing It seemed I haven't found any of the IRS explicit FAQs or use cases that they provided, but it seems consensus in the CPA community that it's not just simply like, hey, I'm a retailer and you had to close your store.
Right.
That if you truly are quote unquote disrupted, and so if part of your business model meant employees gathering together to meet, and they were unable to do so, or required some type of a face-to-face, maybe you don't have a physical location at all, maybe it was all your employees work virtually, but it required them to meet face-to-face with clients, and if they're unable to do so, there's a lot of area in the fringe here that qualifies under disruption. You have any guidance there?
Well, and you're right, because I believe there were a lot of questions that the IRS had that they spelled out a little bit more in detail with their guidance that they actually provided for the CAA. In that, some businesses didn't have a reduction or, weren't impacted necessarily by the government disruption. Their gross receipts went down because they couldn't go out and visit with their employers and stuff. But they opted in to say, well, because of that, I think we'll just shut down for a while, because that was a voluntary decision and it was not that, that was really necessary in that way. Those individuals wouldn't be qualified for the employee retention credit. So it's if the business just said, it's tough right now, so we're just going to shut down for a couple of weeks and take it. If it's a voluntary item, they just disqualified themselves for that period of time. And those are in some of the FAQs that the IRS provided out there, retroactive for the 2020 period. Keep in mind. But for the most part, if you can show your gross receipts that you've had that impact, or that you did have a government disruption, and because of that ruling, it impacted, one of those two impacted your business, you can qualify. And more often than not, the small business employer is not usually financially at the spot where you can just say, oh, I'm going to take a vacation while we're waiting for this to blow
Right.
over, and it's okay. Most of them are working their heart and souls into their business, and so this is the lifeline, and so they're not ready, willing, and always able to just shut down. So more of those employers, this is what's allowing them to reach out and be engaged and have this employee retention credit at their access, because it was, a requirement either for shutdown or because of those things they were impacted. But if your business is solely remote and it wasn't impacted that way, and there was a voluntary, I think we'll just, cool it for a while, that portion gets disqualified.
Yeah. All right. We'll come back. We'll come back a little more detail on that one. And then last one here for the bottom row here, credits available. So pretty gigantic change of the 50% of up to of $10,000 in wages, aka $5,000 if you hit that max, versus 70% of 10 per quarter with CAA and ARPA. On paper, this represents a heck of a lot of money, as we kind of looked at a prior slide here. But I think it's also safe to say there's going to be fewer people qualify as the economy recovers. But what this does is provide a bigger, a stronger, if you will, safety net for those businesses that are heavily impacted. Is that how you see it, Terry?
Definitely. And keep in mind that even with each of these, it's your $10,000 in wages, including your employer benefit of providing health care to your employees. Remember, it's not the benefit that is taken out of their check, but the benefit that it costs you to provide that medical benefit too. So the $10,000 is really quick and easy in some cases to get up to, so that you can get that credit, that 50% and now 70%. I think because it was so slow in the beginning, and we started with 50%, thinking that was be great, that's $5,000 per employee, that we realized that it didn't help recover as quickly. So then that's why they boosted it to the 70%. But this potentially has a lot, especially as when we walk into the CAA where it covers from January through June, and then even with the American Rescue Plan that picks up July through December, that becomes on a quarterly basis and not on an annual basis. So instead of having just a total of $5,000 credit for 2020 for my one employee, I now could have $7,000 per quarter,
Yeah,
which
yeah,
is significant. I mean, yeah, from 5,000 to $28,000. This is the heart of trying to stimulate all of that business entity to be able to bring us back to recovery and help the small businessman get back on his feet faster. And even though we know that more likely is hopefully at the end of this year, we're going to have more stimulated, business and everything in the marketplace, that this is going to be reducing in its availability, we will have gotten cash into the marketplace where we can get, everybody back on the road to recovery faster. And that's what the
yeah.
whole intent purpose was.
Yeah. All right. We spent a lot of time on this slide, but I think it's important because this thing is, it's called one thing, the employee retention tax credit, but it's taken many lives, and it kind of covers different periods of time. Let's go a little deeper on each of these topics now. And so kind of pick up where you just left off there. What is, and let's talk more detail about the amount of the credit for these three bills. So it's CARES, which is all of 2020. It's the Consolidated Appropriations Act, which is Q1 and Q2 of 2021, and ARPA, which has plenty of stuff in it. The American Recovery Act has a lot of stuff in it for all of 2021, but specifically as it relates to the ERTC, it adds Q3 and Q4. But let's just take these one at a time and talk about how we get to the amount of the credit for each of these.
Well, for the CARES Act, again, remember we were looking at those 100 employees or less and that qualification. We walk in and we have 50% of the qualified wages paid to the employee plus the cost to provide health care to that employer benefit. And that allowed us to be able to say, okay, for all the employees that we have, if I'm under 100,000 or if I'm under 100 employees, I've got the availability of looking at all of the wages that I paid to my individual employees up to $5,000 for each of them. And when did that happen? Which quarter in 2020 did it happen that I have that amount, that I can actually go out and say $5,000 worth of potential credit and how I can amend to get that credit per employee. Now, in the CAA, it then says, okay, for 2020, yeah, same ditto, but I can, because I'm now not under PPP, boom, I've opened up those quarters for me to review my employees again and make available funds that were never available before for those PPP guys. That's big. Next step is it looks at January 1 through the end of June and says, I have 70% now of that same $10,000 plus the qualified wages, which were including the cost of benefits, providing healthcare benefits to those employees per quarter. That's 2 quarters worth of dollars that I can look at. So that becomes $7,000 for first quarter and $7,000 for second quarter. I don't get to just cut it off now at the first $10,000 for that employee and push it away. I can say if he earned $10,000 in the first quarter, I got it. If he's earned another $10,000 in the second quarter, I got it again. So we have more. Then the ARPA says, oh, and we're going to tack onto that the 70%, including, your providing health care benefits to those employees for the last 2 quarters of 2021. So it's even made it's allowed us to carry it even further. So for some of the small business employers, like you showed in your the one slide, that this is a significant piece. We've got the PPP where, you've got to disqualify those wages so they're out of the running so we don't double dip. But the whole thing is that for recovery for our employees and our employers, this is a lot to look at and a big boost. The issue that we're being challenged with right now is how can we get this money back to the employer as quickly as possible so that they can get this back into their processes of business.
Yeah, right. So the kind of easy math that I think about for the 2020, so the 50% of up to 10,000, the first 10,000 in wages. So if you've got somebody who's making, I mean, it's really just Q2, 3, and 4. So you can't say $40,000 years, but basically like a $50,000-$60,000 a year employee is going to get their $40,000, I guess, right? In
Definitely.
in Q2, 3, 4. But in 2021, if you just think about a $40,000 a year employee, they're gonna, if they're like a salary employee, they're gonna get their $10,000 per quarter. So that's probably a way to gauge. So if you've got part-time work, you've got minimum wage work, you got students, whatever your scenario is, it's likely your employees may not earn enough to actually hit these credits. But if you've got higher compensated employees that are making more than $40,000 a year, 2021, you're going to hit these limits presumably.
Yep.
Yeah. Okay. All right. So that's the easy one, right? It's understand what money is on the table. Let's go one layer deeper now and talk eligibility.
Eligibility, basically for CARES, it was pretty much, we're looking at the wages that were paid, whether you had fully or partially suspended lockdown orders and or what were your gross receipts. If they were 50% of the gross receipts for that same quarter in 2019, boom, you're good. If you're not, oh well, you didn't make it. And remembering that we cannot be looking necessarily at any of the PPP wages. Where CAA came in, now I've got information that says I could have been suspended, but let's take a look at those quarters of 2019. And if the gross receipts were less than 80%, which is a little higher, then I can go ahead and qualify that way. So I've got more room for people to qualify. With ARPA, they pretty much went through and they said, okay, we can do that. And we're going to look at the 2019 and the gross receipts. And if they were less than 80%, we can compare those. But under that, we have some windows of opportunity that we're looking at because we haven't really received guidance yet. But those are also saying, if I have an employer that is, maybe they had other challenges, or if they are having other items that would put them into, how am I going to say this, into a gross, it's requalifying some of the other looks, because there are some employers that will qualify if they weren't in business in 2019 and such to be able to look at the current quarters. So we've got a little window of opportunity for some of those other employers. So then now I can start comparing gross receipts in 2021 to be determining whether I'm qualified. And that one's one that's going to be really interesting to see how the guidance plays out, because that could potentially mean if I don't have it and I exceeded it or whatever for 2019, I can look at the current, or if I wasn't in business in 2019, how I can look at it so I can still qualify. So it's got a lot more open areas that more employers might be able to be qualified or eligible.
Well, you know what? I won't go too far down the path because it will take a lot of time. But it is interesting with the new laws. So like under CARES, you had to be an existing business, right?
Correct.
The purpose was let's inject cash into the system to keep employees on the payroll, don't put them on unemployment, and get through this presumably short burst, right? And so if you were a newly formed corporation, you didn't qualify. But as we all know, the new entity registrations in 2020 was off the charts, because as people did get laid off and their lives were disrupted dramatically, even if you didn't lose your job working from home, people coming up with kind of side hustle and side gigs or starting their new one-person entrepreneur shops. You could be a new business and still qualify for employer retention in some scenarios for 21.
That's correct.
Hey, let me ask this. So for 2020, go back to the U.S. Chamber of Commerce, 23% of businesses had to shut down, presumably a whole bunch more than that were at least impacted, right? So if I'm a restaurant, I might not have been shut down, but I had to go to curbside only. Or if I was a gym, maybe I didn't, and I was in a scenario where I didn't have to completely shut down, but I had to go to 25% capacity or 10% capacity, something along those lines. So we know if you are impacted in such a way for 2020, you qualify. Is that also true for 21? Because there's a lot of, so like we know, California, for example, big area where there were still shutdowns, but an awful lot of the country wasn't quote unquote shut down like they were in April, in January, February, and even March, but many businesses still today across the country operating on reduced capacity requirements, right?
Exactly.
Do these quote unquote shutdowns and interruptions from health orders, do these still qualify for 2021?
I believe that they do. I think that for the most part, a lot of that is that we have to look at, again, the gross receipts for the most part as well, because we can show that for most employers, they can look at their gross receipts to see how it applies. And now with the like CAA for up to June of this year, we can look at the impacts and see, did it reduce me 80, down to 80% of where I was at for 2019, which is better than less than 50% of 2019.
Yeah.
And also, as we go forward into the ARPA, the only concern that you need to start looking at is, even though we've got that same thing, because they carried the CAA over for those last 2 quarters, we're looking at how does it relate to my current year quarters? Because if I can show that I'm not recovering as quickly, and again, we need more guidance from the agency on that, but if I'm not recovering as quickly and stuff, I may still be able to start comparing what was my second quarter 2021 gross receipts compared, and then does that make me eligible for third quarter? And then third quarter, what was my gross receipts compared, so that would qualify me for eligibility for fourth quarter of 2021. So they've expanded some of that out there to be able to hopefully make it so that we're working our way up the steps to recovery.
Yeah.
Yes.
All right. So if I think for now, an awful lot of the focus is going to be on 2020, right? There's still so many unanswered questions for 21, and much of 2021 still lies ahead of us. And with the gross receipts being the kind of the core litmus test, Q1 just ended yesterday, right? So gross receipts aren't even tabulated for most people. So putting more focus on 2020 for now. If I was one of the 23% of small businesses shut down, no brainer, I qualify. There's some material additional portion is impacted by partial shutdowns or whatnot. So let's say it's another 25%. So you got half of small businesses impacted. For those that have to go into the gross receipts test only. So you didn't have to shut down. You were still able to talk to customers over the phone because that was your business model. So you can't qualify under the government order shutdown kind of litmus test. It's only based on gross receipts. If it's on gross receipts, that doesn't automatically make you eligible for the entire year like the shutdown does, right? So let's just talk a little more detail. So it is March 20th. My county executive just shut down my business. Excuse me. March 20th. My business didn't get shut down, but all of a sudden, panic in the marketplace, and sales just fell off a cliff for me, right? I'm an online store perhaps.
Yep.
Sales fell off the cliff. And so I have a 51% reduction in gross receipts in Q2. does that doesn't mean that I qualify for ERTC for Q2, 3, and 4 automatically. What would be a scenario? It does mean I qualify for Q2 and
Correct.
for Q3 the following. What has to happen to make sure I qualify for Q4 as well?
Well, what you need to do is we need to know what were the gross receipts for the next quarter. You know that your gross receipts, you were down 51% for that first quarter. So that makes you eligible automatically for the second quarter. In second quarter, if your gross receipt still remains below that 50%, you've just now made yourself eligible for third quarter. If your gross receipts go over 80% in your comparison, so second quarter, I'm sitting May, I'm looking and I've got a gross receipts that now puts me at 83% compared to 2019, same point in time. That means that I am no longer eligible the first day of the next quarter. So in May, if I found out that I hit 83% of my gross receipts from 2019, that means starting July 1st, I'm no longer eligible for employee retention. So I
So,
still was able to get it for first quarter and second quarter. And first
yeah,
quarter, remember, it was only from March 13th to the 31st, but
so
I
this is going to be
had
a big
those
deal.
two.
This is a big deal for small business owners to understand. So
Yes,
again, if I'm impacted by a shutdown or partial shutdown, I qualify for the entire year.
correct.
But if you were not impacted by a shutdown, and I'm just going to just use round numbers for easy math, so everybody can kind of follow it and tell me if I got this right, Terry. I got $100,000 in sales in Q1. Q2, I have $49,000 in sales. So I had a 51% drop in gross receipts, right? That automatically qualifies me for ERTC for Q2, and it automatically qualifies me for the following quarter, Q3. But in Q3, if my sales were, I got this the 80% number now, right? So if my
Right.
sales in Q3 were 79,000, AKA 79%, I'm still below the 80% threshold and I qualify for Q4, correct?
You're right. That's correct.
But if in Q3 I have $81,000 in sales, I am over the threshold. In starting October 1st, Q4, I'm no longer eligible for ERTC.
Right. And remember, we're comparing gross receipts from that current year, 2020 to 2019 at the same point in time, because that percentage of change is based on the difference between 2019 at the same point in time. So instead of like the previous quarter,
Yeah,
I'm
you know
only
what?
looking at the year ago.
Yeah, you know what? I botched that. That's a really good catch, Terry. So it's not sequential quarters. It is
Correct.
the same quarter prior year from 2019. But
Right. But
hopefully everybody follow. I just tried to do that for easy math. It was easier for me, but it's not sequential quarters one after the other. It's how that, whether it's the 50% rule and the 80% rule based on the same quarter prior year.
right. And yet to add to that confusion with the ARPA, because we've got the changes that they're looking at with the severely financially distressed employers, and we've got the items where they're looking quarter to quarter, because some of those are eligible to look at sequential quarters when we get into the second half of the year for some of those special employer eligibility. So yeah, we're walking that fine line because there's going to be some employers that are going to fit that ability to compare quarter to quarter later on this year when we get more guidance.
Yeah, yeah. All right, let's jump ahead here. I'm looking at the clock. What is the maximum credit amount? I think we kind of touched on this, but I think especially some changes here with ARPA.
Maximum credit amount, again, with CARES, we had was the $5,000 per employee. I believe that's it's pretty much, that's 50% based on the $10,000 per employee. They didn't really necessarily put a cap on it for an employer. For CAA, they then boosted it up to $7,000 per quarter. And then again, that's from January to June. But when we walked into ARPA, they then started looking at putting a cap on it. We've got the $7,000 per quarter, and that's for third and fourth quarter of 2021. But they also added a $50,000 per quarter maximum credit. And that's basically only for the recovery startup businesses, but they started looking at some of that because now with ARPA, they've got it out there, and depending on guidance, it's going to be interesting to see how that plays out, because they're also providing policing action, I guess you could call it, or how they can qualify or reevaluate to ensure that there's not any misuse. So there's more rules, again, like you indicated earlier, on how the agency can evaluate that, make sure that we're not exceeding our ability to take credit.
Yeah, so really the only additional ruling here as part of ARPA was for the recovery startup businesses. Let's jump to this and this whole credit eligibility, whether employees are working or not. This kind of goes back to original intent, right? So in 2020 was the 100 employees was the demarcation, and 500 employees in 2021. So you briefly touched on this at the top of the conversation, but just make sure everybody understands all employers can participate, and maybe share, you and I were talking yesterday on this, Terry, how, for example, Starbucks, clearly over 100 employees, so, they still took advantage of this. So just the difference between a small employer versus a large employer participation.
The thought process in CARES Act was that to be able to retain employees, so you have the employer that has 100 or less, and he can take in consideration wages that he paid to his employee, not FFCRA, but all other wages. And for the employer that has over 100 that was able to do that, he had to qualify the types of wages he paid. He couldn't use all wages. He couldn't use FFCRA wages either. But in addition, he had to look at, these are wages that I'm paying the employee to retain them, but they're not working. The Starbucks situation was, I know of a couple of the stores and everything that while they closed their stores down because of mandate, they paid their employees to be employees still. They still got paid even though they weren't in there brewing coffee for everyone until they could recover, because it was an upfront. We know our employees need money. This is a tough time, so we're paying them to not work. This wage was also not paid, or one of those payments that an employee puts in for his paid time off leave. That doesn't get included in employee retention credit for this over 100 employees type of situation. It was purely wages that were specifically paid by the employer that were not paid time off, not scheduled leave or sick time, but were actually just wages paid to the employee to not work so that they could bring them back and get started as quickly as possible. With CAA, they're not looking at that type because we've now boosted it up to the 500, and we're saying, okay, less than 500. I believe that is for January through June. They're not going to go back to the retro, but we're looking at now, it's more so, it's not that I'm paying them not to work, but I need to make sure that what am I paying them for? In many cases, it can still be because you're paying them not to work, but again, I still can't double dip. I can't use FFCRA wages. I cannot use, paid time off leave wages, but I'm looking now at the employees that I'm paying. And I believe that with ARPA, and these are one of those that we're still looking at a lot of guidance for 2021 because that hasn't been released yet. But we're looking at, okay, have you qualified these types of wages? For the most part, it doesn't sound like they've changed that yet. In the legislation, it doesn't say, hi, we're changing the types of qualified wages, but they've expanded and made it so that you've got more employees that you can get the Retention Act, the retention credit for. So it's pretty much opening up that window.
Yeah. Okay, let's. I would take on the last topic, and I think we're going to do another webinar just on this one because this is so nuanced, right?
It's so huge.
Yeah. So on the surface, I think this is really straightforward, and I don't think people are generally going to get in trouble with the IRS so long as they if they, regardless of their methodology for calculating qualifying wages, they can demonstrate that they're not double dipping, right?
Very much, yep.
Yeah, I mean, so FFCRA, that's the Family First Coronavirus Response Act, that basically said, hey, if someone's gotta leave work for taking care of a loved one or get sick or whatever, that they get paid for that, and so you can get a tax credit for that. So you can't double dip there. If you got a PPP loan, and the purpose of that PPP loan was to pay paychecks, that's the Paycheck Protection Program, that's what it's for. That's great. You can do that and ERTC, but you can't get a tax credit for money that we already gave you for free in PPP, so you can't double dip there. Can you just kind of put some, and I don't want to scare people away with this, but this is wonky stuff. This starts getting very nuanced very fast. Can you explain why?
Part of it is because of it would be really nice if we could just slice and again with the way they started it with PPP and or retention credit, but we keep this separate so that you can't combine. Now with the requalification of the employer that received the PPP but can go back and get the employee retention credit in 2020 and can go forward, we have to make sure that the employer is, again, like you said, not double dipping. With ARPA, now there's going to be some rules put around that too. So when you have your paycheck protection loan going on, it also now looks at, did you get forgiveness? Did you get forgiveness on the whole amount? Did you get forgiveness on a partial amount? Did you declare it? That you, for the most part, as a quick guess, don't use your PPP loan information for employee retention credit, because that was your credit. You got paid back for that, and hopefully with your forgiveness. Most cases, they're trying to get forgivenesses going out there. But another thing to add to the mix is that we've got PPP2. And again, you can't, again, with that intent of hoping that you get that application and you get it in there for forgiveness. If you get 100% forgiveness, those wages are totally untouchable to be used for employee retention credit. Now, the gray area goes into, well, what if I didn't get full forgiveness? And that's a big one, because that happened with CAA. That's when they started slicing and dicing. And it's one of those, did I declare it? Did I not declare it? If I did, then I didn't get it. And how much can I use? If I didn't declare it, I can't take it. That's where the big gray area happens. But for the most part, as long as if you're using FFCRA, boom, you got that sick leave, family leave, you cannot use those wages for employee retention credit. If you've got a PPP loan that's got forgiveness, you can't use those wages for employee retention credit. That's a double dip. You can't do that. And with ARPA, if you try to double dip, employer will be held responsible, because there'll be penalties. And now, instead of the agency looking back on 3 years usually from filing deadline, according to ARPA, they're going to open it up to 5 years. So the potential policing action to make sure that you did the right thing could last a little bit longer, which means that we could be getting more notices in the back after that. So
Yeah, right.
This one's big.
You know what? It's sometimes you wish you would have known the law changes early, before people filed for forgiveness of their PPP loans. But this is where it's going to get a little crazy, I think, in the coming months. But probably also lessons learned for the second draw PPP, because just looking at the clock, if you got funded second draw in January, you're 8 week, if you're in an 8-week window versus the 24 forgiveness period. I mean, no one's filing for forgiveness yet, basically, right? For the second draw.
Correct.
But you think about a scenario like, let's say you got $100,000 in PPP funds. The law said you had to use at least 60%, aka 60,000 of that on payroll. The rest could have gone towards personal protective equipment. It could have gone towards interest on mortgage. It could have gone towards rent and utilities, right? Which means 60,000 is your don't double dip, not the 100,000. But if you were someone who easily exceeded, you had a lot more payroll dollars than you did a PPP loan, And so just to make it easier on yourself, instead of gathering all the receipts for utilities and rent and calculating mortgage interest and all that stuff, you just simply said, oh, here's all my payroll dollars. I easily exceeded $100,000. Just ensure me to be forgiven. Well, now all 100,000 is going to count against that. You can't double dip. If you're going to be really super techie on this, and you could have architected your forgiveness plan, you would have included all those other expenses, because that would have been fewer dollars counting against the double dip, right?
Exactly.
Yeah. So I think it's water under the bridge, and we shouldn't feel too bad, because I mean, it's not free money, it's taxpayer money. This is coming out of everybody else's pockets, and this is a safety net we provided for businesses who are struggling. So, it's water under the bridge for 2020. If you've already applied for your PPP forgiveness, most people have. But for 2021, there's going to be some real strategies involved about how you apply to then coincidentally also maximize your ERTC.
And a lot of CPAs are out there assisting employers exactly with that, because they've been keeping an eye on that. We've been engaged with the AICPA, with NPRC, a lot of acronyms there.
Yeah.
But those groups are looking at this, and we're speaking with lending institutions and keeping an eye on that, because there's a lot of looking at, well, if I can take the employee retention credit now, let's do it while I can get money back in there. And then let's see how we can address it with the PPP loans, so that we don't double dip, but that we can get our biggest bang for our buck. So there's a lot of review and analysis going on out there as well.
Yeah. All right, let's just take a couple minutes on one last topic here, Terry. I mean, I think there's a lot that we don't know yet. So it's one of the things that we rely on is all of these FAQs, these IFRs, the interim final rulings that come from IRS. Talk about just a handful of these buckets that it's not just we as sure, it's no one really knows yet, and we're all kind of waiting on guidance from Treasury here.
You're right. So far, we kind of know what we know about CARES, because we received a lot of IRS guidance on that. CAA, we received with that release of the bill in, I believe it was March, early March, we received actually the IRS guidance that assisted us in how to address amended returns and how to take care of that ERC for 2020, but we were still pending the 2021 piece. So there's a lot of the items that we were still in question about. What is the election that's conditioned for the that January 1, 2021 to June, with regards to the eligibility for the credit, how it applies to the 80% of our gross receipts. And yet for most of the American Rescue Plan, we have no guidance yet. So that's telling us we're stepping into the July 1st through December 31st. Is it going to be similar to what the first half of the year is going to be? What about the special conditions for those recovery startup businesses? What about that gross receipts question of the 80% again? When am I able to look at 2021's second quarter to compare to make sure third quarter I qualify or not? Or will it ever make it eligible just for all employers? Is this only going to be for certain employers? We're looking at aggregate businesses and how that applies, because they've pretty much given us a clear cut on how it works for most of them. But again, with the ARPA, did I get disqualified? ARPA also opened up, and with CAA 2 opened up some of the government entities that in past were not eligible, which became somewhat eligible. We're looking at how to advance or get advance to the credit. We know with CAA, they said, yes, we're going to continue to use the Form 7200. I can't use Form 7200 for the past, so that's off limits for 2020. How am I going to do that for my 2021? We kind of got that, but now with ARPA, okay, so now I've got guidelines saying that if I over ask for my credit, and I take more than I'm supposed to, my penalty, because I'm gonna get penalized for taking more than I reported? Or does it go based on the calculation? Because I could look at it and say, well, today I didn't overtake it, but at the end of the quarter, based on how other things happened, did I put myself in a bad spot now, or I'm in a better spot? So there's a lot of questions on how this is going to come across, how it's going to impact our processing. Do we need to have break aparts for periods? Yeah, there's a lot of guidance that we're still looking at to help us go with 2021. So I think for the most part, most people are saying sit tight until we get the next one. I anticipate we should be getting guidance at any point in time, at least for the CAA piece for 2021, since we're already at the end of first quarter. And we're getting ready to file first quarter now, and we're already into the second quarter. We're going to have guidance before the end of June so that we can do it right.
Right. So let me kind of begin to wrap with this. So I'm hoping we answered a lot more questions than we created here. There are still a lot of unanswered questions. It just is what it is. And just rough order of magnitude. There's Small Business Administration says there's about 30 million small businesses in the U.S. Chamber of Commerce says about 23% of those experienced a shutdown in Q2 of 2020 due to COVID. So, you're talking rough order of magnitude, 7-8 million businesses right there that no brainer qualify for 2020. Very few of them applied for the ERTC credits last year. There's a gigantic opportunity for a huge number of small businesses that there's not a lot of ambiguity. This is easy, low hanging fruit. Yes, you qualify. The additional qualifications around reduction in gross receipts, or if you weren't explicitly shut down like a retailer or a gym or a restaurant or a bar or a theater, maybe room for more interpretation whether you qualify. There's going to be truly millions of fringe cases here when you think of 30 million small businesses.
Yep.
That you've got to consult your CPA. That's the best option. Also tax attorneys to determine your eligibility. But once your eligibility is determined, I don't want to oversell this, but I also want to make sure everybody understands the stakes you're playing for 2020. So even if we don't go, future looking, because the dollars get real big real fast in 2021 at 7,000 per head per quarter. But just retroactively, $5,000 per employee for a 10-person company, that's $50,000. I mean, that's no joke, right? And that means really meaningful stuff. So it's taxpayer money. It comes out of all of our pockets, but it's a safety net that was built for you to take advantage of. So with that, we're going to do follow-up webinars, Terry. Always get smarter every time I talk to you. So I'll be inviting you back real soon, probably next time we get additional guidance, and probably need to unpack more detail around this double dipping issue with PPP funds. In the interim, everybody, we have added a new section to our website. So if you go to the website, assuresoftware.com, and right in the top menu, it says COVID-19. We got our COVID-19 Resource Center, as we have for the last year, where we have all the on-demand recorded webinars, just like we're talking today. We got PPP loan information, application forgiveness information, guidance from the Department of Labor, FFCRA, PPP, SBA, etc. There's a ton of tools there for you. But if you look in the top right here, we've also added a new section around the employee retention tax credits. And if you are an existing Assure client, we have all the 2020 data, and we have the ability to calculate this and take kind of the mystery out. What could take many hours of spreadsheet hell, forgive me, we can probably use our systems and tools to help calculate this very quickly. And because we are a tax filer on behalf of all our payroll clients, we can file these amended returns for you, and we'd love to be able to talk to you about that. If you are not an Assure client, there's a good chance we can help you, even though we may not have your 2020 data in our systems today. So long as we can get the data in good, clean ways, I think there's a lot of ways we can really help. This is big money that's on the table, and we want to be a resource for you to help you get everything that is available to you in the form of stimulus. So if there's anything we can do to help you, whether you're an insured client or not, we do have the ability to help calculate information probably much faster in a more streamlined way, and then file the 941 amended returns, these quarterly employer tax returns, to get you the stimulus that is available to you. So Terry, as always, thank you so much. I appreciate your time.
Thank you.
And with that, this is what we do. We're here to help small businesses, providing payroll and HR services for over 60,000 of them, in hoping we can help you in this way, and hopefully today added value. So until next week, talk to you guys soon. Thanks.